You ever wonder why so many smart people, maybe even you, seem to struggle to actually make money in the stock market long term? It's like one of the biggest puzzles in finance, and today, we're going to crack it. Let's dive in.
It's a pretty tempting thought, right? We all secretly believe we've got what it takes, that we can be the one to pick the winning stocks at just the right time. But what does the cold, hard data actually say about our chances?
Well, the reality is kind of staggering. Study after study shows that a whopping 80 to 90% of all investors, and yeah, that includes a lot of the pros, fail to do better than a simple, boring market index fund over the long haul. So the real question is, why? Why are we so consistently getting on our own way?
Okay, just a quick reminder before we really get into the weeds. This is all for educational purposes. It's not financial advice. You should always chat with a professional about your own situation.
All right, so the single biggest reason for this massive underperformance, it isn't some complex economic theory, it's not some Wall Street conspiracy, it's us. It all comes down to plain old human psychology.
And this right here perfectly captures the two most powerful and destructive emotions in investing. When the market is flying high, greed and that infamous fear of missing out, FOMO, they just take over. Everyone feels like a genius. But when the market takes a nosedive, all that confidence just vanishes, and it's replaced by pure, gut-wrenching fear.
And these emotions, they push us straight into this wealth-destroying cycle. We get excited and buy when prices are at their peak because everyone else is making money. Then we panic and sell everything when prices are at rock bottom just to stop the bleeding. We're literally doing the exact opposite of what we should be doing. It's the classic mistake.
But, it's not just our raw emotions that trip us up. There are other, more subtle forces that are constantly working against our portfolios.
So, there are three other major performance killers we really need to talk about. This idea of trying to time the market, being a little too confident in our own abilities, and the slow, steady drain of costs. Let's break these down one by one. First up, market timing. This is the dream of jumping in right before the market shoots up and then jumping out right before it crashes. It sounds amazing, right? But in reality, it's pretty much impossible because in the short term, the market is just completely unpredictable. And this is exactly why timing the market is so dangerous. Just look at this. Over a 20-year period, if you just stayed put, you got the full market return. Awesome. But if you were jumping in and out and you missed just the 10 best days, your returns were absolutely crushed. And the crazy part is, those best days often come right after the worst days, exactly when most people are too terrified to invest.
Next up is overconfidence. Look, we all like to think we're a bit above average, right? But the numbers don't lie. Even the pros on Wall Street, with their fancy degrees and teams of analysts, struggle to consistently pick winning stocks. To think we can do it from our laptop is, well, a very classic and very costly mistake.
And finally, let's talk about costs, because they are the silent killers. Every time you buy or sell, there might be a small fee. If you're trading all the time, you're going to pay more in taxes. And if you're in one of those actively managed funds, you're paying higher fees for the privilege. They all seem small, but they're like tiny little leaks in a bucket, slowly but surely draining your returns over time.
So if trying to be a stock market genius is basically a recipe for failure, what's the alternative? Well, the answer is surprisingly simple. It's about switching from playing an active game to a passive one.
And this slide really breaks it down perfectly. See, active investing is all about emotional, frequent decisions, high costs, and trying to be the hero that beats the market. Passive indexing, on the other hand, is systematic, it's disciplined, it's low cost, and the goal is simply to match the market's performance.
So, what on earth is an index fund? It's simple, really. It's just a fund that buys all the stocks in a major market index, like the S&P 500. So instead of trying to find the needle in the haystack, you just buy the whole haystack.
And the advantages here, they directly solve every single problem we just talked about. It yanks emotion out of the equation. The costs are incredibly low. It completely avoids that impossible trap of market timing. And it basically forces you to be a consistent, long-term investor.
Okay, let's bring this all home. Because choosing an investment strategy isn't just some abstract thing we do for fun. It's about actually achieving your real-world financial goals. For a lot of us, that big goal is financial independence, maybe even retiring early, what people call FIRE. And the path to FIRE isn't paved with a bunch of risky bets and lucky stock picks. No, it's built on a foundation of steady, reliable, and predictable growth over decades. It's all about winning the long game.
So, after all of this, if you take away just one single thing, let it be this. The biggest risk to your long-term financial success is not a market crash, it's not a recession.
It's our own behavior. Mastering our emotions, staying disciplined, and sticking to a simple, proven plan, that is the real secret to winning at investing. The market is going to do what the market is going to do. Your job is to control the one thing you can actually control: yourself.